What is going on, everybody, and welcome to another tutorial. Now, in this tutorial, what I'm teaching you about is how to draw out supply and demand and how I play supply and demand. Now, you have to understand that there's a lot more than just drawing it out and playing a zone to zone. That you have to take a big thing to consider when playing these is that you have to be watching for current events. You have to be aware of what's going on. So I do videos on daily updates and weekly updates with events going on, because you have to understand that events could change supply and demand and cause a stock momentum to break completely through zones very quickly. This is why, if you're aware of this ahead of time and depending on the time of day, because normally around that mid-afternoon you start getting a lot of news typically, and normally when that happens, the supply and demand zones they can break very simply on events. So just be mindful that these aren't always 100%. But given the current market state, you have to also understand that technicals are hardly breaking out. They're all breakout and failing, and understand that supply and demand has been very solid, very consistent, even through all the different cycles and the different events that have been going on. But the biggest thing to be mindful again is that you want to be patient and for the stock to reach these particular zones, these demand zones before you're going long, or the supply zones before going short, and understanding that. So going into it, I want to kind of map out Disney here a little bit, just to kind of show you how to do it. Now, if you're going intraday, I advise you do 1 hour. If you're doing any kind of swings or investments, to be mapping out the 4 hour or the daily. It's all the same way of doing it. It's just a different time frame depending on what kind of time frame you are looking at. So again, we'll go ahead and map out Disney here. But as far as demand, what you're looking for is multiple touch points where the stock reverses. So if you look at this, I mean, this is on the daily. We can do it on a daily because it's probably actually cleaner than on the 4 hour. Let's see, get a little bit larger here. We can even do it on the 4 hour here. So as you can see, there's multiple touch points here. A lot of people will just say this is resistance and they'll draw a line. But typically for a supply zone, you would essentially map this section out. And because you're looking for almost full body candles, you have to ultimately understand, yes, you're going to get wicks out of this. If you're going to get fake outs, which happens a lot nowadays, but ultimately you're looking for multiple touch points. So what you're looking for entry, if you're looking for perhaps a short on this one, you would be looking to get as close to that second line. The top of that zone is where you want to enter. But it's not to say that that's going to be absolute for certainty, because a lot of times you have the bottom of the zone here, and then you get a touch point like this where it just briefly tags that bottom of the zone and then reverses back down. So if you're getting multiple tags on that zone, that's what you're looking for, especially if you get like 3 or 4 tags here. You got 1, 2, 3, 4, and then it really starts to sell off. If this actually came back up and tagged it, that would be a good entry, because you know it would flush from that point. If you get multiple tags and it's still not breaking, normally that means it's going to flush to the downside. And it's the same for the upside. Should have probably actually started with upside, but because I know that can get a little confusing. But again, multiple touch points, and sometimes it can be really hard to draw, especially for this demand zone down here. I would probably pick something like this. Again, there's multiple touch points here. Again, this could be, you have to understand too, when you're drawing these wicks down are institutions. So institutions trade off of supply and demand. So that's one thing to keep in mind, and understand that supply and demand really originated from Forex, and essentially has been brought over to the equity side. And so being said, these wicks, institutions are trying to get in. So they're trying to liquidate, because they know a lot of people have stops here. So they try to liquidate their position so they can fill these massive orders that cause these stocks to have these massive spikes up. And a lot of times, if again they haven't gotten quite filled, as you can see, it attempted to break out and it came back into the zone a couple times. Again, if you are watching closely here, these wicks didn't tag all the way on the bottom, but they were holding that zone. This is why it's better to have a zone than just a resistance line, because of that fact, because you know the zone here has, again, multiple touch points, multiple entry points, and then you always have that stop there. Sometimes what I like to do is I like to go, if I do have a wick down like this, I try to capture the institution entry and try to watch for that institution entry. And if I can be lucky, snipe that. But ultimately, I understand that institutions will try to do that. And again, it all depends on events. If there's no real event and it just spikes down like that, this is why I like to watch the 1 hour, because the 1 hour will really kind of tell you the story of what's going on within the momentum of that stock. So again, this is your demand zone, essentially. Again, you're trying to get filled on the demand side. Once there's enough demand, it will push up into supply. Again, something I always talk about, that first attempt is always going to get rejected. Now, sometimes you'll get, depending on what the news is, sometimes you'll get a massive push. Again, if there's really positive news or really negative news, you get that first rejection, and then sometimes this is even shorter. This doesn't take multiple days. Sometimes it's just a quick day rejection, and then it breaks through. But majority of the time, it'll reject pretty hard. It'll take multiple days, and then it'll reattempt to try to break it. If it can't break it, from that point, it'll continue to sell, like you see here, or it will attempt a couple different times and then either break or go up. So that's something I always to watch, is how many times you're getting touch points on these zones. That's what matters. And again, the first one is always, if you're trying to go for an overnight scalp, it's perfect for that, because you get a massive move. As you can see here to the downside, you get a massive move pop here for the first touch point to the bottom side. And then again, you could be adding a dollar cost averaging on these touchbacks in the zone, as long as you got a stop here for equities, or you could even put it back, that stop down below here from that wick for a possible institution entry. Again, you see an institution possibly stop hunt there, and then you see a deeper one here. This is why you have to be careful on some of these. You still want to be tagging out of this. If it does come back into the zone, then you can jump back into it and then keep that stop loss tight, and then continue watching it to push back up. Now, not everything is a zone. You can say that this could be one. If you're looking for like an intraday play, you can draw another zone here. Again, multiple touch points. This may be good. Depends on the stock. A lot of the stocks I play, they got bigger moves, so I wait for the bigger supply and demand zones. There's these like speed bump zones where there's a little bit of consolidation, and then just for a brief rest before it pops back up again. You can do that if you're doing like intraday or next day trades. I think it's great for that. But ultimately, you're looking for the bigger reversal points on again a chart, and so you can see that a lot better on the daily. Again, if you're doing like investing and stuff, this is fantastic for entries, and then you kind of know where to exit too at that point. Like right here is another great spot for entries. Again, multiple touch points on the daily. You get all these wicks and touch points here. It's a great support. And then here's a great supply zone right here on this top end, 185. So you got these massive moves like this. So if you were able to put an order here, get tagged in, the best thing to do is to set your orders, and then if they get filled, they get filled. If they don't, they don't. And that's the best way to keep it. You want to keep any kind of emotion out of it. So when it tags you in, you're okay, you're aware, you get an alert on that, set alerts for that. Hey, it did tag me in, where it hits your zone, and then set your stop, and then just let it ride. And then when it tags back up here to the top zone, you can essentially, you want to be moving your stop up as well. If you are watching this, if you do get tagged in, it's a good example. Say you got tagged in here at the 168 mark, your perfect entry, the stock goes and breaks above the zone, you're going to get a retest on this typically, or some sort of a little pullback to try to retest it. And so if that's the case, and it retests successfully, and starts to push up, then you set your stop right underneath that. You let it continue to ride up. And then from that point, from every essential candle, this is kind of why I go off the 1 hour. I try to watch it closely. So say you get an entry at this bottom zone here, and it starts pushing up, break, retest. As you can see, this one candle here is retesting. If it's successfully retesting and then starts popping back up, then you set your stop right here. Until then, you try to keep that stop at break even. So nonetheless, you at least come out even. And then on the push up, you move that stop into the next zone. So if it breaks above this zone and starts to hold, then you move that stop right there, right underneath. Especially when you're coming into a zone, what I always do, as soon as it starts getting into a zone, I run that stop really close. So say I got an entry here, it came back into the zone, I got an entry in this touchback, and then it starts pushing up, touchback, and move the stop up here, break, touchback, move the stop up here, break, touchback, move the stop there, break, up. That would have almost essentially touched me out. Of course, on this play, considering that if I was in this, if it was this close to the zone, I probably actually would have raised my stop up to here to the 137 mark. And then this particular candle will probably actually tag me out. So I want to capture everything. It's better, you can't capture a full move. It's better to sell when there is momentum in the stock. So just be mindful of that. And that is extremely important because liquidity is important to be able to get in and out. This is why you shouldn't trade every stock, and especially crypto. Liquidity can be concerning if you're playing a stock that doesn't have a lot of liquidity. You're not going to be able to have much success unless you're just investing and believe in the project. Or if you're trading stocks, it's different. As long as you're playing some of the bigger cap, that's why I like playing bigger caps, because liquidity is there's a lot more liquidity in those stocks. So that's essentially how you do it. It's pretty simple. Again, base it off of what you're looking at as far as time frame, and then base your time frame in which you map supply and demands within that time frame you're looking at. And then again, make sure to take profits when you start when it starts to push up, when you get tagged in. Just be mindful of these things, and you can do some really great things. So being said, if you have any comments or concerns about supply and demand, leave those down down below, and let some other people know what you've learned about supply and demand. Help some other people out. And until next time, I'll see you guys later.